All right, so this afternoon, we're going to be looking at risk management strategies. Last week, Wednesday, we looked at the introduction to risk management. I would say that in Forex trading, generally in trading online, there's a risk involved, just like any other business. Forex trading is not different. There's risk involved in every business and every business venture that we do. But the issue is that some businesses have a higher level of risk compared to some others. So high level of risk will also bring in a high return, while a low level of risk will bring in a low level of return. And in that class, we looked at different ways we can apply risk management in Forex trading. We looked at the position sizing, we looked at stop loss, risk reward ratio, diversification, and many others like that. So the essence of today's class is now to go into the practical side of how to apply risk management. That's why we're talking about the strategies that we can use to apply risk management on our trades. Now, the first topic we look at that day is actually position sizing, and that's what we're looking at first today. Position sizing is one of the ways we can practice risk management. All it talks about is the percentage of your equity that is exposed to the market per time, how to know the percentage of equity that is exposed to the market per time. So how do we apply our position sizing? Now, this is a practical session, so I'll take you to a website where you get to do all this. So I'm going to flip over now to my Google page from where we'll go to the website that we will use this tool. So I'm flipping over right now to Google. All right, you'll see that I've switched over to Google. Now you come to your Google search bar and type position sizing calculator. And you click enter, and you see the position sizing calculator will appear right here. And the first one is from the website babypips.com. That's the one I prefer to use. So I'll click it, and you have it right here. You scroll down, and this is a position sizing calculator. So we're going to use this now in this example to show how we can really manage our risk with proper position sizing. You can see on the left column, we can see the account currency, account balance, risk percentage, stop loss, currency pair. And on the right side, we see results. Now you can see under the result, everything is 000. We have not inputted any data onto the left side, so there's no data yet for the result segment. We're going to put in data now to the left-hand side, then we'll click on calculate, which will now give us a result on the right-hand side. So let's start. So let's assume we have an account size of $1,000, that's account balance for $1,000, and we're risking just 2% of that account per trade. Remember in the last class, I said that professionally, you're not expected to risk more than 2% of your equity per trade. Now let's assume we're doing day trading and we're risking just 30 pips on each trade. So we're going to click the calculate button. Now you can see under the results menu, everything is just 0000 all through. So we don't have any data there yet. So I'll click on calculate now, and you see that this other side will be populated with data immediately. So I click calculate, and you can see the data is populated already. Under amount at risk, we have $20. Then the position size, is for every of the other segments, depending on the category of the lot size. But I'll select this one, label standard lot size. So the interpretation of what we just did now is that if you're trading with a capital of $1,000 and you are risking 2% of your account, it means you'll be risking $20 per trade. That's what this one means. Yeah. And for you to risk $20 per trade, it means the recommended lot size you should trade with will be 0.0667 lots, which you can approximate to 0.67 lots or 0.067 lots or 0.07. That's the highest level you can approximate it. 0.07 lots is what will give you a risk of $20 per trade. If you remember in the last class, for those who joined that session, we said If you have $1,000 and you're risking $20 per trade, which is 2% of that capital, you will need 50 consecutive, 50 back-to-back losing trades in order to wipe that account out. That's provided you don't know how to trade. So that means that with a minimal risk, you can stay longer in the market. The goal of trading is to make profit. But while trying to make profit, we also need to be very, very conscious of how we manage risk. Because if your risk is too high, then your account will get blown up faster and you'll be out of the market. But if you are risking just 2% of your equity per trade on $1,000, you'll be risking just $20. And the recommended, now this is the area that most people find very confusing. Most times people don't know the recommended lot size they're expected to use. And that's the reason why I'm showing you this. If you have $1,000, you are not expected to use more than 0.07 lots. That is what is safe for that account. Now, let's look at somebody that is risking like 10% of his equity per trade. So we'll put 10% here. We'll leave every other data the same way. I'll click on calculate now, and it will give us the data for a 10% risk. You can see that I've clicked 10%. It means if you're risking 10% of your account, you'll be risking $100 per trade. And the lot size that will give you that amount is 0.333 lots, which is approximately 0.3 lots. You can see here the lot is higher. The higher your lot size, the higher the risk you're taking per trade. In reality, the bigger the profit you will make. But at the same time, it also means if the market doesn't go your way, the bigger the loss you will likely make, on your trade or on your account. So a risk of 10% is high. And the lot size I'll give you that is 0.3 lots. So you have to be very, very careful of your lot size. Lot sizes are not meant to be used randomly. They are not meant to be used, without caution. Use it with a lot of caution. For emphasis sake, lot size, a big lot size will give you big profit. But most traders, they only consider the profit aspect. They are not looking at what if the trade did not go well in my direction? What will happen to my account? Now, this person that is risking 10% of his trades, which is $100, he only needs 10 consecutive or back-to-back losing trades for him to get that account wiped out. 10 losing trades back-to-back, and the account is wiped out. Compared to the person that is risking 2%, which is $20, that needs 50 losing trades. The person that needs 50 losing trades, by the time he's even having close to 5-7 trades, he knows he's supposed to stop trading. His account will still be safe. But the person that is risking $100 per trade, with a 10 losing trade back-to-back, $1,000 is gone and it's out of business. So use your risk management, wisely in order to protect your account and to be in the business for long. Let's look at another example. Let's look at an example of a $5,000 capital and you're risking 5%. Still 30 pips stop loss to calculate. Now, for someone using $5,000, you can see the person will be risking $250 per trade, and the lot size that will give that amount is 0.8 lots. 0.8 lots. Now, with $250 risk per trade, this person will need about 20 losing trades to wipe out this account. It's still a bit fair, but it's better if the risk is minimal. But the risk here is in between the 2% and the 10%. It's not up to the 10%. It's a little higher than the 2%. But then it's still better to maintain the professional standard, which is 2% risk on your capital for each trade that you take. For the benefit of those who might just be joining us, we're looking at risk management and we're looking at position sizing. Well, there's websites, that can help you calculate your position sizing effectively online. It's from babypips.com and it's called Position Size Calculator. I believe when you watch the video again, you will get to understand what we've just done. Now, aside from the position size calculator, so okay, let's take it a little bit closer. So let's assume somebody's watching this webinar this afternoon and you say, oh, I don't have $1,000, I don't have $5,000. What I have is just $500 to trade. We'll check it out for you. So if you're trading with $500 and you're risking 2% of the capital per trade, it means you'll be risking $10 per trade. And the lot size you need to trade with will be 0.03 lots. You see, when it comes to lot sizes, it's better to maintain the same lot size for your account. Not that you use 0.03 today, tomorrow you use 0.5, next tomorrow you use 0.01. No, maintain a standard lot size recommended for that account. So if you have an account of $500, you should not exceed a 0.03 lot, no matter what is happening in the market. Just stick there with your 0.03 lot. Oh, you are there. You said, but all I have is just $300. We got you covered. $300 with 2% risk. What you'll be risking per trade, you'll be risking $6 per trade. And the lot size you would use must not exceed 0.02 lot. Now, if you follow what I just showed you this afternoon, you discover that you will stay longer in the forex market. You will not be blowing your account, so fast like maybe you've experienced in the past. Now, aside position sizing, there are other ways to also practice risk management, which I will still show us right now. And one of the other ways is through setting of stop loss. Stop loss. Stop loss is very, very important, to your trading career. Exactly how you set it can determine whether you'll be in the business for long or you'll be out within a short while. I'm switching over now to MetaTrader. Now, people have different opinions on how stop loss should be set. Some believe in using a fixed number of pips. Some will tell you that, oh, I used 25 pips stop loss, and that's my fixed stop loss for all currency pairs. The truth is that that may not be safe because each currency pair has its own spread, has its own characteristics, has its own volatility. For a currency pair like Euro USD, maybe you're scalping or you're doing some day trading, probably 25 pips may work. But for a volatile pair like Euro GBP, like a GBP JPY rather, or Euro JPY, a 25 pips will get hit within a matter of minutes. So generally speaking, stop loss cannot be fixed number of pips when it comes to trading. It varies based on market conditions and based on the specific instrument you're trading. So you can't have a fixed stop loss. That's all I'm trying to say. It will always vary. So the question is, so when we have variable stop loss like that, how can I set stop loss effectively to protect my account? Now, one of the best ways to set stop loss and even take profit is by using resistance and support. Resistance and support is one of the best ways you can use to set a stop loss and take profit level as a trader. So let's look at an example of this. Let me try to find. All right. Now this is Euro AUD on 4 hours. This is a 4-hour time frame. Now this is pure analysis. I'm not giving signal here. It's just, purely showing us what is happening on the chart. So it's not a trading advice. Now we can see here that price hit a resistance level. So generally we anticipate, a bearish movement in price. Now price has moved away slightly from that level. So we expect possibly a further bearish movement in price. Now, if we set a bearish trade on this particular instrument, that's a Euro AUD, we can as well. Now, let me use the rectangle box to indicate this region. Right. So if you're looking at a bearish opportunity on this particular instrument, and let's assume we're setting a take profit maybe somewhere, around this region here. Then we can use the resistance level, possibly the tip above there, as the stop loss. Why will we use resistance level as a stop loss in a bearish trade? Reason is this. One, resistance level indicates that the selling pressure is more than the buying pressure, so the price will generally drop lower. And usually, if price drops low, even if there is a retracement backwards, it is still within the resistance zone. There's a high tendency that price may still fall down backwards. I mean downwards rather. So the resistance level can be used as a stop loss level that I don't envisage price breaking, even if it retraces back. I don't see price exceeding this level without it coming down. Or if at all it breaks out above this level, then I'm done. I will take my loss and walk away with whatever loss I incur on the trade. So resistance levels can be used as a stop loss level in a bearish trade. The same thing in a bullish trade, the support level can be used as the stop loss. Like now we have a support level here, and we might as well maybe target the next resistance level as a take profit. The stop loss can be below the support level. Take note for the resistance, the stop loss can be above. Let it be a little above. Now we don't use the exact figure of the resistance or the support. We had some few pips, maybe like a 5 pip, above it, just to play safe in case price, enters into that zone, and so that you don't get taken out easily, and put it on 5 pips above, 5 or 10 pips, depending on your personal, discretion. The same thing if you're using the support level as a stop loss in a bullish trade, some 5 pips below the support level will just, suffice. So we can use support and resistance for our take profit, and even more like what we're talking about now, more as our stop loss levels as we trade. And also we can use the recent high and the recent low, as our stop loss also. Like in this case now, this is the recent low. So if we are anticipating a bullish trade, we can use this low as the stop loss. Until this place became a resistance, it could have been used as the recent high as price is trending up, and we can also use that one. I mean, apologies, this is the recent high in this place. We can as well use it also as a stop loss as we anticipate price dropping lower. So support and resistance zones, recent high and recent low can be used as both, even both as take profit and a stop loss level while trading. Another way to effect risk management is what is called back testing and demo trading. Back testing and demo trading. And we discussed this in the class last week. Now, before you start implementing any strategy, it's advisable for you to first of all back test that strategy. And back testing simply means going back in history to check if that strategy had worked well in the past or not. That is what will now help you to make an informed decision whether you want to use the strategy now or you want to discard it. For example, one of the key principles of trading is the support and resistance. Now, we're going to do back testing. Back testing means you are going to be drawing your chart backwards. You will left click on your chart and hold your mouse and be dragging into the past, into history. So I'm doing that now. I'm dragging my chart. I'll drag it as far back as maybe 20. I'm on the daily time frame. So I want to drag it back to, let's see, maybe as far back as 2010. So I'm going to see, okay, my charts can only drag to 2015 at the moment. It's still fine. So we're going to check if support and resistance had worked in the past so that we can use that to judge whether it's going to work today if we see one. All right. So here is a resistance zone. And when price hit the resistance, what happened? You can see selling. That means resistance worked. This is 2015. Let's go again. This is another resistance zone. This is 2016. Resistance price moved in the bearish direction after hitting resistance. That means resistance worked in 2015, it worked in 2016, and here we have a support zone that spanned between 2015 and 2016, and we can see that price reversed into the bullish direction. That means resistance and support worked between 2015. All right, apologies for the little break. So that means that resistance and support worked in 2015 and 2016. So we keep now dragging to the front and checking in recent times if it still worked. This is 2016. Now this is daily time frame. If we scale down lower to 4 hours, definitely we'll see more. But I've identified one again on the daily time frame. This is a support. Support worked again in 2016. Let's keep moving forward. This is resistance again in 2018. All right. This is a resistance again in 2019. Here we have support in 2019. We have another support in 2019, this whole region. Okay, this is 2020. This is a resistance in 2021. We have a slight resistance here in 2022. You can see the bearish movement after price hits the resistance. We have a resistance in 2023. We have a support in 2024. A resistance in 2024. And this is 2025. Okay, we still I think identified one again. We have a support earlier on in 2025, and currently price is testing a resistance in 2025 again, right here. So you can see that between 2015 and 2025, there are different instances for this particular currency pair, especially on the daily time frame, where we saw that support and resistance at work. So what we've done now is what is called back testing, going back in history to see if that strategy had worked well in the past or not. So if it had worked well in the past, then it will work well now. We have this cliche in trading, especially in technical analysis. We say that history always repeats itself. And that is what I've just showed you now. So if there's a specific strategy you want to use, back test it, check it on the chart, going back in history, at least 10, 15, 20 years in history to confirm if that strategy had worked well in the past. So if it has worked well in the past, then there's a high probability it will work, in this present time and day. Now, the second side to this is called demo trading. Demo trading. Now, while backtesting requires you to go back on the chart, demo trading requires you to test the strategy now. You are trading it, you are testing the strategy now by placing trades. Backtesting doesn't require you to trade. It's just you going on the chart to see what had happened in the past. Whereas demo trading requires you to actively trade now to see if the strategy is working now. Now, there are two types of accounts you can have on P Prime platform. There is a demo account and there is a live account. Now, a demo account is a practice account. It's a simulation of a real account, meaning it behaves exactly like what a live account is doing. So the same price you see on the demo account is the same price that is available on the live account. The same chart movement you are seeing on the demo account is the same as what is on a live account. So what's the difference between a demo account and a live account? The difference is this: the trading funds you have in your demo account is a dummy amount of money, is not a real amount. It is the broker that puts that amount there strictly for you to practice trading. So a demo account is a practice account. The money there is not real. Whereas in a live account, there you have real money that you put into your trading account by yourself. So when you make profit on your demo account, you cannot withdraw it. It's non-withdrawable. And the same way, if you lose the money in your trading account, PO Prime is not going to hold you responsible or accountable for it. But if you make money in your live account, it is real money that is withdrawable to your bank account. And also, if you lose money in your live account, well, it's a real loss. So, but it's ideal for you to practice first with a demo account before you go into live trading. Now, some people want to, jump all these processes. They just want to get a strategy today, start using it today, and they end up in trouble. So first things first, you back test, you demo trade, then you cannot graduate to trading live with your account. So if on the platform this afternoon, you don't have an account with PU Prime, then you have to start one today. Just visit our website, straight away. I'll type the address here. That's www.puprime.com, and go to the section where you can open a live trading account, and you open one. And peradventure you are here, somebody has reached out to you from PU Prime, who likely is your account manager. They've sent you a link. Go and click that specific link that person has sent to you to open a live trading account. Okay, I believe Frank is just joining us. I've just said a lot of backtesting, and you're still asking this question. I said backtesting means you need to go back in history. I've demonstrated that. Maybe you joined us a bit late. You might just have to go and watch the video again to get an understanding of what backtesting is. But generally, it's looking back in history to see if a strategy had worked well in the past or not. If a strategy had worked well in the past, and there's a high tendency it's going to work today. If a strategy has not worked well in the past, there's a high chance that it's not going to work again today. So before you use a strategy, you need to first of all back test it by going back in history, flipping your chart to the back to see if it had worked well. And if it had worked well, then it means you proceed to the next stage, which is demo trading. And I just explained demo trading now as you practicing with a demo account. And if things still work well with the strategy, then you can now proceed to the third stage, which is live trading. And for you to trade live, you need to have a live trading account with PU Prime. And I just share the link for that right in the comment section. Go to www.puprime.com, open a live trading account. All right. I believe you got that. All right, you're welcome, Frank. All right, so this afternoon, I'll just do a little recap now. We've looked at how to use a position sizing calculator to manage our risk, to know the level of lot size specifically that we can use on our trade, and the specific amount of dollars you may be risking per trade. So for those who are just joining us, I will encourage you to watch this video again so that you can get a proper understanding of how to set your lot size and the number of account size that you are risking per trade with your position sizing calculator. And we've looked at how you can set your stop loss and even your take profit using support and resistors, and also how you can carry out back testing and start and also go to demo trading before you go live with your trading account. So these are the three risk management strategies we're going to be looking at this afternoon. In subsequent classes, we'll intimate you with more strategies. So if you're on the platform this afternoon, you have a question to ask us on this same topic we just treated, you can go ahead and unmute your microphone, or you can go ahead and type it in the comment section, and I'm very much available to answer you. Now, before we go into that, if you're still there also, you have not been to our physical training, I tell you are missing a lot. So we have physical training twice in a week on Tuesdays and Thursdays at our two locations in Nigeria, Abuja and Lagos. So tomorrow is a physical training day. Make sure you find your way to any of our physical offices for this training. We are not charging for it, but then you're expected to have a live and possibly a funded account to join this training session. So the address for the Abuja office is PU Prime Africa, Abuja, Work and Connect Building, 50 Ebitu Ukiwe Street, Jabi, Abuja. And the time is 10:30 a.m. both on Tuesday and Thursday. And the address for the Lagos office is PU Prime Africa, Lagos, at Agos Executive Business Lounge, 54B, Adeniyi Jones Avenue, Ikeja, Lagos. And the time is 11 a.m. for both Tuesday and Thursday. And don't forget to also join our 5X group. 5X group is a specialized signal group where we drop high quality signals for our clients with the aim to help you push your account from the level you funded it to times 5 of that amount over a period of time. And there has been amazing testimonials from that group. It will help you grow your account. So if you're not yet there, please reach out to your account manager and tell them you're interested in being a part of the 5X group, and they will guide you on how to connect to the group. All right, so the floor is open for questions. You have a question, type into the comment section. You can go ahead and unmute and ask me your question on this particular topic we have treated this afternoon. So the floor is open.
Okay, I have a question, sir.
Go ahead, sir.
Okay, the question is that I was backtesting on my chart, and most of my backtests I was using trend line to. I was clarifying the places where there is a breakout
Okay.
before maybe uptrend or before downtrend. So
Okay.
there's this, but currently now most of them do the test before they break out the test then start going up, or break out the test before going down. But not most of them do the test. What could be the reason, or is it just that's how the market is?
All
In
right.
most of those, okay.
No, continue. You say most of those what?
Most of those things, not all of them do the test. So that's just my question. I don't know.
Okay. On what time frame are you checking this breakout and retest?
Like currently, I was checking on 15 minutes time frame.
Okay. Now, the thing is that on lower time frames, there can be a lot of instability in the market. Lower time frames like 1 minute, 5 minutes, 15 minutes. The market can be, sometimes those time frames are regarded as noise. On the higher time frame, there is a better price stability compared to the lower time frames. So that could be responsible for what you are seeing, why the test and retest is not working. But even though test and retest is a valid technical principle, there are times when it also may fail. So nothing is 100% guaranteed. We can only look for high probabilities. High probability could mean that out of 10 trades, maybe you have 7, and it's possible for 3 occasions it doesn't happen. So we can only talk about high probabilities. So if you're checking on lower time frames, that may even reduce your chances, of using that kind of strategy. But it's a good one that you actually had gone, that route of back testing to see if that strategy really worked on lower time frame or not. So if you want to get more results with test and retest, the higher time frame is actually better. You can check out for your test and retest on a higher time frame, like a 4-hour daily, then, or even 1 hour. Then you can now use your 15 minutes for entry. But check for the test and retest on a higher time frame and focus more on entry on the lower time frame. I hope that helps.
Yeah. Thank you, boss.
You're welcome.
I appreciate it.
You're welcome. Another question? Any other question? All right. So I think in the absence of any other question, we need to bring this webinar to a close. Please watch out in your WhatsApp group or the Telegram group I belong to. Once we are done with the downloading the recording, we'll post it on our YouTube channel. And from there, we'll send a link to your groups. Make sure you watch this video over and over again so they can get a clear understanding of the concept that has been shared. And watch out on Wednesday. We'll come again with another webinar like this where we'll give you education on how to trade Forex and become better and more profitable traders. All right, I'll sign out here right now. Take care and enjoy the rest of the day. Bye-bye.